More about the state of foreign investment in the U.S. Yan Liang, Associate Professor of Economics at Willamette University, joins me now live from Portland. Thank you for joining us.
Thank you, Rachelle.
So as we know, the United States is the largest recipient of foreign direct investment in the world. How are the country's policies about trade and tighter immigration impacting the investment appeal of the U.S.?
So these kind of market-driven cross-border investments are very beneficial for the economies. It helps the companies to get market access. They're able to serve the local markets. They're able to allocate capital more efficiently around the globe. So companies are able to build their supply chain globally, and they're also able to acquire business know-how and foster cooperation and collaboration with their partners. So all these market factors are driving the cross-border investments, and U.S. being the largest recipient of the direct investment. But as you just mentioned, with all these political uncertainty, with President Trump in office, having all these unpredictable economic policies and measures to achieve economic goals, I think this basically signals to the rest of the world that business interests can be compromised for other priorities. And I think that definitely sends a chilling signal to business around the world. Right now, I think, yeah.
Well, I wanted to make sure that we understood just how much this can really impact the U.S. According to Select USA, the most recent data from 2016 found that FDI directly supports 7.1 million jobs. And the UK tops the list, but China has been one of the fastest growing FDI markets for the U.S. Just how costly could the drop in Chinese investment be overall to the U.S. economy?
I think it will be a significant negative impact on the United States because the drop of the direct investment from China is very significant. At the beginning of your segment, it talked about the Chinese direct investment in the U.S. dropped from 29 billion in 2017 to now only $4.8 billion. And so with that, you will see less business cooperation in, for example, tech development, which is very costly, and it could be very beneficial for companies to pool money capital and human capital together to develop technology, and that is a priority of President Trump. Not to mention, as you talked about, the employment effects. I think the United States have been always talking about creating jobs, and yet it's shutting off those foreign direct investment in this country to produce jobs. One interesting side note is that the venture capital investment across borders between U.S. and China has actually increased. China invested the venture capital investment in the U.S. On the order of $3.6 billion, and the U.S. invested $19 billion venture capital in China. So together, this is more than the direct investment. And the interesting thing about this is because venture capital is more opaque, it's less regulated, and that's why it's overtaking the direct investment.
So clearly there is still interest. So in this current trade climate, what should foreign investors looking at the U.S. keep in mind?
I think specifically China, diversifying industries and locations are very important. The U.S. just passed the FIRMA, the so-called Foreign Investment Risk Review Modernization Act, in August last year, which basically puts a stringent stance on Chinese investment in the U.S., especially in the tech sector, even if the Chinese company are just taking a minority stake. So I think one thing for Chinese investors and investors from other countries is to diversify, not just in the tech sector, but maybe expand to other sectors like finance, tourism, health, energy, transportation, and so on and so forth. The other thing I think is these days businesses are taking this wait-and-see approach. Everybody is waiting for this late June meeting between Xi Jinping and Trump, and hopefully there were some positive breakthroughs in their trade talks. But even I think trade tension escalate, it could still produce mixing effects because for some of the market-oriented businesses, they might still want to produce and invest in the foreign market so they can directly sell to the market to avoid tariffs.
So how does the White House's strategy on foreign investment compare with what you're seeing from state and local officials in the U.S.?
I think that's a very interesting question. I think state and local governments are welcoming foreign investments because, again, this is good for their local economy, it's good for their business, it's good for their consumers, it's good for their workers. But at the federal level, with President Trump, it becomes more business unfriendly for a lot of these foreign investors. For the Chinese investors, a lot of investments are concentrated in New York and California. So I think one thing that Chinese businesses can do is to diversify their locations, both within the United States and outside of the U.S.
And just quickly, if you had to name some sectors that you see having significant changes as a result of this trade dispute, which investment trends should we keep an eye on?
So as I mentioned, the tech sector is increasingly sort of unaccessible for foreign investors in the name of national security concerns. So last year, 40% of China's venture capital went into biotech and pharmaceutical sectors in the U.S. But because of the FIRMA and because of the increasing scrutiny of the U.S. government on Chinese investment, I think some of the tech-related sectors are becoming difficult for Chinese to access. But again, there are other sectors that are lucrative, and I think that would be less strict for the Chinese investments, such as agriculture, entertainment, finance, and transportation, energy, and so on and so forth.
All right, thank you so much. Always good to have you. Yan Liang there, Associate Professor of Economics at Willamette University.